Hello, Theo Traders. Here's your nightly report for Thursday, April 21st. My name's Doc Severson, and what I'm looking at here is a chart of Google. What I've done differently on this chart is show the extended hours here. So the extended hours are showing in the light gray, and the reason why I'm looking at extended hours is the earnings just came out. I don't know what the actual numbers are, but price says everything right now, and the price has gone from about 780 to a low of 717, and is trying to bounce valiantly from that low. We'll see where things open up tomorrow, but this could have a huge effect on the NASDAQ stocks as well as the other indices, much in the same manner that Netflix earnings caused a little bit of weakness in the charts the other day. Going out to the daily chart of the major index charts, here's the S&P first of all, and while this is not a key reversal bar and today was not tremendously bearish, if it was, we would have dropped more than just 10 to 12 handles that we did here today. But regardless, it at least showed that we are starting to see something kicking in here. Yesterday's price went higher on much lower market internals. So in other words, like the S&P 500 advancers was just about dead even with the decliners, and yet the market pushed higher yesterday. And usually when we start to see the market advancing on lower highs on the number of S&P advancers, it's just about time for a pause. So what I'm looking at here is I'm more short-term neutral on the market. I am more intermediate term bearish, because of the fact that we have this monster weekly move here, which has been almost uninterrupted all the way up for 300 points, which is nearly a record. I don't think I can find any other 300-point moves in such a short period of time over the last 20 years. Now, I don't want to get into the debate of overbought versus oversold and those kind of things. Basically, what I've found is that the market just doesn't respond to overbought anymore, at least in the way that it used to, especially since we got into central bank policy and quantitative easing and things like that, which just created distortions in the market that we were not used to seeing. So to me, those tools no longer carry the effectiveness that they once did within sideways markets. This is anything but. However, we undoubtedly have some kind of overhead supply sitting up here at these levels, and it's going to be tough to chew through those last points. Think of yourself climbing a mountain, starting out by running up the side of the mountain, right? And as you run further up, you start to get a little bit more fatigued, and then basically by the time you're getting to the top, you're completely winded, and you're just basically going on momentum alone. And so it's easy for you to fall down at that point, and I think this is what we'll probably end up getting, at least in the next couple of weeks here, or as we get into May, is we're going to have some volatility return. Even if it's just a consolidation pattern here, you can bet that the first red candle that we see on the weekly chart is going to cause people to freak out, because right now they're back into the mode of just buying the dip. They're not used to this anymore. We've completely forgotten anything that we went through back in January and February. So it's back into bull mode. So the first red candle that shows up is going to create quite a reaction. And for option traders, that's good times, because that's something that we can sell. So ultimately, I think this will lead us to some form of higher low. And I would say it's probably going to hold at least above the 2000 level, although we have Fib levels that are well above that right now. But this is certainly going to hold at least above 2000. And I think if it does pull down to that level, it's going to give us some tremendous opportunities to be selling put options, whether they're in spread form or just naked form. Now, what happens after that low is put in, that's going to be the big question. That's the $65,000 question that we're going to be reading into in 2016. At this point, after such a performance like this, it's hard to overlook that. I'd be surprised if we don't start to push higher from that point. But again, I don't want to have a bias into this. I don't want to have any dog in the fight if we end up printing a lower high and rolling over from there. So quickly going through the rest of these charts, here's the Russell. and the Russell 2000, and we're wondering if this trend line is going to fall or hold at this point and set up a lower high. Now again, the same thing goes here with the Russell. If this rolls over and turns into a higher low, that wouldn't necessarily be a bad thing. In fact, sometimes that's necessary for a chart to be able to recover by stoking up too much excess negativity. Now, the Russell got punished earlier, well, into last year and earlier this year because of the fact that a lot of these small cap companies were energy companies, speculative, like shale drilling, things like that. And of course, when the energy market, the bottom fell out of that, so did the prices of those companies if they still stayed in business whatsoever, right? So a lot of this move down from the Russell was a direct result of that. So if and when energy recovers, we're going to see an equal recovery in the Russell, or at least we should. So looking at the NASDAQ, now the NASDAQ is going to be interesting. Again, this is a weekly chart here. The NASDAQ has been showing, this is almost I hesitate to say head and shoulders pattern, but this is definitely a lower right shoulder here from a head pattern. So that is not necessarily a great sign from the NASDAQ. The NASDAQ should be leading markets higher, but it and the cousin Russell have been sort of trailing things down here. And everything's been heading into the Dow because of the Dow with its, guaranteed yield dividends and things like that. This has been attracting all the capital, kind of in a safe harbor for this market right now. But it's printed a higher high, and so the chances now of any low being a higher low are definitely increased. So on this weekly chart, we're starting to see a little bit of selling coming in here. Let's take a look at the daily. And on the daily, definitely had some profit taking today where we were down by almost 1%, about 0.8%. Almost an outside day, but not quite. Almost a key reversal bar, but again, not quite. So just another red candle in a sea of green that's here. So bound to catch people's attention, but we'll see whether or not the Google event for this afternoon is going to increase profit taking for tomorrow. Again, driving markets towards a new and higher low is always a good thing in an uptrend. But seeing the market come down, depending on what happens with Google over the next day or so here, is actually a good thing if you're looking for markets to ultimately go higher in the longer term, because you can see along the way, you can pull down any bull market that you want to, but ultimately what happens is markets need to retrace and stoke up that negativity if they want to go higher. Sometimes they have to take a step back if they want to take 2 steps forward. I'll close out today's video by looking at the daily chart of the 30-year bonds, and we have a pretty significant lower high setting up here on the weekly chart. So pulling out to the weekly chart, you can see this is potentially a lower high, and if it actually closes below this level here at 160.30, then that would create that change of polarity to the downside. Now we have a longer term trend line coming here, so it could still find some support down here. But normally what we see is when the bonds sell off like this, we typically have some upside in the equities, but last day or so here, we've had all assets come in slightly. So everything has to breathe, right? Everything cannot continue going higher forever without taking a step back. So that's it for tonight's report. Thanks for listening, folks. Have a great evening.